Hello, everyone. This is Mark here at TSLA, and Tesla did okay today compared to the rest of the market. Tesla is up 0.95%, closing at $282.48, and that is on today, July 5th, 2023. It's up a little bit after hours at the time of this recording, which is about an hour before the after hours trading closes. And the rest of the market, not so good today. So seeing some outperformance with Tesla is great. It could be coming off the back of a lot of the other auto manufacturers reporting decent EV results. I believe GM is up like 100% year over year, year over year. Yeah, and Rivian is in negotiation to sell their Amazon designed vans over to the vans designed for Amazon to other customers. But I don't know if they even fulfilled all the orders for Amazon yet. So this could just be a sentiment thing for Rivian, along with it being really beaten down compared to Tesla. I think it was down a couple of weeks ago, like 95% from its high. So I guess people that hold Tesla shares should be a little bit okay with that, considering we're down around 40%. But let's zoom in. Oh, actually, let's take a look at the higher time frame first. So this is the daily, and I was taking a look at the July 21st expirations for options and kind of trying to understand where a lot of the option action is going on due to the 19th of that week being the earnings report for Tesla. So I was curious where the volumes and open interest were at. And based off what I saw on a lot of open interest and volume sites, specifically just even looking at your broker's options chains, for puts, it's in this bottom box here, and I saw a lot of almost in the money puts building up earlier on in the day for the 21st of July. And I also saw a lot of people interested around 260. There's some 250, but more volume on 260. So this is kind of what the support could be for a lower end of things. This, 2 weeks out, 1.5 weeks out from earnings. As far as where interest is going for on the upper end of things, some calls are building up at the 315 and 300. 300, obvious, it's just a nice round number, but 300 has been getting a lot of action for weeks now. But for 315, you're starting to see build up a volume on 315. Open interest is building up on both of these. There's some other flyers around 350 for Tesla at the end of the month, but that's really far out. That's far away. I'm sorry. I don't think that's going to be too realistic. But what could happen is, let's say things go really well. Let's say tomorrow we have a good ADP jobs number. We discussed this in yesterday's video, but we have some employment numbers coming out over the next two trading days. Let's say ADP comes out decent and non-farm comes out decent, so it doesn't look like we're in a recession, and then we can resume trading like we have a soft no landing, meaning that we're not going to have a hard landing, which would equal a pretty tough recession, and we can continue trading up. Like I said, I've been using this volume profile to kind of show you guys where interest has been historically for certain price points, and we're kind of in an area that doesn't have a lot of interest just because it's kind of below the range of some previous consolidation. But if, let's say, things go really well over the next week and a half, and we find ourselves at the 300 price point, like there's not much above that will interest people in selling. This could be one of those things where it gets sucked up due to this vacuum here in the profile up to around the 330 point. Something to look into, but for now we're still respecting the range, and that range is going to be up to this high that was back in September of 2022. I'm assuming this is going to be our short-term high as far as in our range, and though we could see 300, if you do see 103 before earnings, it's going to give you a really good chance to okay, look, that's just a pretty good move after having another large, really good move. It's going to make you think about what you want to do to protect your investment. Are you going to want to sell some calls, or you want to buy some puts, or going into earnings? But buying calls and buying puts at earnings isn't really the greatest play anyways. Selling premium is actually really good. I'm selling a nice expensive call because as Tesla's going to get closer to right here, the 19th of July, the implied volatility, or the IV of your options, are going to get much more and more expensive. So you might have some really nice opportunities to sell some premium and use that premium to even like hedge your upper end or upside risk by getting some out of the money calls on a shorter time frame. But yeah, really great day for Tesla. Let's kind of go in on a smaller time frame. Let's look on the minute. And I'll delete these boxes just to clean things up, and I'll turn off the moving averages, which are trading all above. So I didn't really talk about that, but we're well above all our moving averages. This is really, really cool. And I'll turn off the volume profile as well. And you can see that our after hours price went up a little bit, so that's not a bad thing. This is really, really nice. So the rest of the market was relatively flat, and I can even maybe just, if I overlay the SPY, does this mess up our chart too much? Okay, but basically you can see that if this was their high, if this is the SPY high, it didn't really do all that much, So it hasn't really broken through its high from the previous trading day on Monday, and it sold off just like Tesla did a little bit, but Tesla's been being bought up after hours, whereas the rest of the tickers, not so much. I think Rivian is doing really well, and maybe Delta, because Delta has earnings next week, but otherwise the market is being outperformed by Tesla. And which is really interesting is that, yeah, I could have expected that. Where does today start? So today starts over here. So let's say, and this was our high, but we actually kind of beat our high out and kind of closed below it. But that was a really good sign because we were getting a lot of buying in the afternoon. We're just about an hour and a half before closing. It was really outperforming. And well, when this got bought up, none of the other tickers were really getting bought up. So either, there wasn't much news, so someone knows something, but there's really not many catalysts other than our jobs numbers over the next couple of days. So if someone knows something, quote unquote, they would have bought up everything else. But this could just be a sentiment thing for Tesla, just because EVs are really doing great. GM had, okay, so for GM's EV numbers, they pale in comparison to their ICE internal combustion engine numbers, but they did increase sales, and Rivian had a really good day too. So this could just be an EV thing, where people are finally seeing the light that, look, EV's catching on. We have the infrastructure to support it now, and Tesla is going to be a leader. And why not? Like, isn't it weird? Like, Rivian is trading at a much higher, seems to be doing a much higher beta than in Tesla, which is fine. If you're interested in kind of like maximizing your plays in the EV space, it wouldn't hurt to dabble a little bit in Rivian. But overall flat, but still a decent close considering how the rest of the market performed. This is just burning theta. Like it's really hard to play some short dated options on Tesla sometimes unless you have those, because once you get a big move, right? Once you get a like this, when you get a big 6-7% move, it doesn't have a strong like multiple dollar follow through necessarily. But I think this is the best we can get. This is flagging. It looks really good. And if you look at the actually, let's look at the hourly time frame. Let's take a look at the RSI. The RSI is getting kind of close to being topping out or being considered overbought on the 1 hourly. As far as the stochastic RSI, we're kind of in the middle. This is a little bit more quicker as far as understanding the trend. So I like to use both, like the slower and the quicker. The quicker is kind of just in the middle of nowhere. And so we can still have a little bit more upside over the rest of the week. Let's just review the day time frame again. Oh, so the day is kind of interesting. So looking at the bottom chart here in the RSI and the stochastic, like looking at the daily, like we have a lot of room to go. Like we can really bowl through this. Like, so looking at the low of the stochastic RSI, that was that kind of sharp sell off that the rest of the market experienced as well. And we kind of dipped into the gap at that point, but we pushed through and we still have a lot of room. So you see when we top out on the stochastic that it's a lot of green, and we have a lot of room to go. And typically when stochastic gets to this point, we're in the middle, I think it's going to continue the trend. Like, barring any news, we don't really know what the news is going to be like in the next couple of days, but it's actually looking really good. And the regular RSI kind of, it stopped its fall and kind of started curving back up into its moving average. So if it crosses through, which it might tomorrow, let's say it crosses through tomorrow, you probably see some upside over the next day or two. That's very possible, something to look out to, but I wouldn't really use that to play any short dated options unless it's just, a really cheap out of the money call bought tomorrow for Friday. The 1 day to expirations can be really nice sometimes. If you, number one, you need to hedge. It's a really good hedge because going to non-farm payroll could be a kind of sketchy situation. But yeah, it's nice that non-farm ends up on a Friday, so you can get some cheap options before. It saved my butt plenty of times where I spend like $20 on a couple options each, and it turns out to be like a 300% gain, and it turns out to be also a very nice hedge against my shares. So I know we overlaid SPY onto Tesla, but let's take a look at SPY real quick. Yeah, it's really not that great. What it was really nice to see though is that a lot of the stocks, they gap down in the morning, let's say, right? They gap down and they got bought up really quickly. Now, why did we gap down? And this is a pretty decent sized gap down. I think we were seeing during the futures market like negative over 0.5%, and so it opened up around just under 0.5% and got bought up pretty quickly, and it kind of maintained this kind of area of interest. This is kind of just we're probably, if I had the volume profile, this would be where the volume profile is going to be at around the 443, which translates to around, I think, 440 4444 on SPX. So maybe just like that number. But it's kind of just, you're in the middle like this. It just, when you run into events, the market puts you in the middle and it lets you have a hard time calling either up or down, because when you're in the middle, it can go either way, and it can go either way in the same direction. I'm sorry, in the same amount. But I think it is bullish that when you are presented with this gap down, which came from all the kind of the weaker PMIs, again from the other markets and just basically other countries outside the United States of America, their economy is just not doing really great. And so what does that mean? Okay, number one, you can say like if a company has exposure, multiple companies have a lot of international exposure, and their customer base is getting weaker overseas, that could be like a negative on their earnings, right? But you can also see another way for stocks where there is a lot of fear in the overseas markets, especially Asia or certain parts of Europe, that America would be kind of the flight to safety, where US equities are going to be where people want to just kind of, if they need to be long, that's where they're going to be long at. And it kind of makes sense. If you look at, people say that, the Nikkei over in Japan has been having a really, really good year, and they're like making almost new highs, all-time highs. But they really tracks just the Nasdaq. So if you want kind of the same exposure, Nasdaq tracks the Nikkei pretty well, and those are all going to be US based companies mostly. So flat on SPY. Let's take a look at the Nasdaq. The Nasdaq kind of, it's very, very similar. It's slightly outperformed, and that could be from a lot of the XLC type of tickers, the communications tickers. Like we have Google and we have Meta doing really, really well today. And you can almost say it's like an advertising story where people are traders and just the overall public is they're asking themselves like, okay, is there going to be a recession? And if there's not going to be a recession, what was the first thing to get hit by recessionary fears, which was ad spend companies, companies that relied on other companies giving them money so they can be advertised on their platform. And who were the two biggest advertisers or platforms? It's going to be Google search, and of course it's going to be Facebook, and that includes like Instagram and all of the reels and stuff like that. So Meta and Google bullying today could be a sign that people are finally accepting that, okay, maybe for now we don't have to fear the recession stuff, and we can dip our toes into the ad world. And I could say as well that Meta has a nice story going where they're releasing a Twitter competitor tonight or tomorrow called Threads by Instagram app. So it's going to be an app. I'm not sure if they're going to have a website where Twitter has that kind of like, a lot of people use the website feature as a feature, and and if they don't, I think that Threads could have an adoption problem if they don't have a web access. But so Threads is coming out, and that could be a good or a bad thing for Meta. But also, if you really think about it, it can be a good or bad thing for Tesla. And so why can it be good or bad for Tesla? Well, it's really about Elon Musk and Twitter, where if there has never been a real strong player in the text-based social media world in America. And so if Threads really takes off, and let's say there's a lot of users that are signing up in the first couple weeks, and we're going to hear from Meta at the end of the month. They won't really touch on Threads because it won't be of that quarter, but maybe they'll take questions. But let's say it has really quick adoption. That could put a financial strain on Twitter. But it also can make Twitter do different things, where they recently allowed people who aren't logged in to start reading tweets again. The limits on viewing posts were lifted. You could say that, okay, they were saying, their story was, look, we have a lot of people scraping data, and we want to find out who those bad actors were, identify them, block them, and then open up Twitter again so everyone can easily consume. But you can also say that when the news of Threads coming out this week happened, I think as a business decision from Linda Yaccarino and Elon, they're like, look, we can't create such a big barrier for people to use Twitter if another option is coming out tomorrow. Likely what's going to happen is that, and I hope it doesn't happen, and something that Elon probably fears and has probably voiced his concern, that Twitter and Threads start just creating a CNN, MSNBC compared to Fox-like atmosphere, where one site caters to one type of political leaning and the other app leans the opposite way. And then all you have is just conversation, basically in an echo chamber, where you're just exchanging ideas with people who think exactly like you, and you're just getting confirmation, instead of what currently was on Twitter, which was a lot of debate or discussion, or Elon liked to put like PvP, where, player versus player, you're really going after each other, which I think is better for society. A lot of people think Twitter is like, oh, Jim Cramer was going on CNBC today saying, oh, Twitter's like a cesspool. Well, the thing about it is it has at least a debate, where any other type of situation after today is going to be like, okay, everyone who's left-leaning is going to be on Threads, and they're just going to talk about how bad right-wing people are, and everyone who replies will be like nodding yes, and the opposite will happen on Twitter. And that's just, how is that better? Because all it does is further divide people. It doesn't expose other people to ideas that could change your point of view. And I'm not saying all ideas do change people's point of view. A lot of ideas are just wrong, but that discussion is going to go away. So it's very interesting to see how that's going to play out. But it's also going to be very interesting to see if that eventually affects Tesla, and affects Tesla's only in the sense of Twitter's bottom line being, I guess, negative. It'd be a big negative for Twitter's bottom line if the Threads app takes off. But we'll see. What I think that won't happen is that a lot of people that use Twitter, like in like finance or Bitcoin or stocks, like I just don't think they can find that same type of audience and post in the same way like they are posting now on Threads from Twitter, that is, because the Threads app is going to be linked to your Instagram account. Now, we don't know if you can make a Threads only account and be completely anonymous. I'm not sure. But it's so much easier if you just want to create a Twitter profile and post and share your ideas. You don't have to go ahead and start like trying to make yourself look real by like posting all the pictures on Instagram and, oh, this is my social life. Maybe we don't have one we want to share, or maybe we don't have one at all. Twitter doesn't have a problem with being anonymous towards other users. Of course, they want verification on the back end. But yeah, I think that would be a limitation for Instagram, where the type of audience in the first place would just be people that like using Facebook or Instagram, not so much having a conversation. Like people are going to be posting like, hey, I went to like Starbucks today. I don't know. I'm curious to see how it's going to work out. Before we wrap up, I want to take a look at some websites. With some there wasn't much news, but I want to share some stuff I found, and we can see if that's going to be helpful to understanding price action for Tesla. And the first things first is the big news that was today, which caused the flatness all day. So it was flat all day for the main reason that at 2 p.m. Eastern time was when the Federal Reserve's meeting minutes were going to be released. Now, in the meeting minutes, essentially it's what, like if you're any other corporate meeting or business meeting, you have someone like taking notes down, seeing like kind of just having a kind of a very broad idea of how the conversation is going on minute by minute, instead of just what we're given at the FOMC meeting, which is just kind of like a Jerome Powell's overall review of the economy and what they're doing with rates. The minutes kind of go deeper, and you can see how individual governors were thinking, understanding why the dot plot is what it is, why, if there was any rate hikes, why they happened, how many people didn't want them to happen, and vice versa. So in this case, there was no rate hike, obviously, and that was pretty much telegraphed really well by the FOMC from the previous meeting. So it wasn't that the result wasn't surprising. What we wanted to know is how many governors of the different Federal Reserves, how many governors were wanting, number one, not to have a hike, number two, wanted to have a hike, or three, okay with a hike now, but wants a hike later, and how severe would that hiking be later? So this is CNBC, and they went on to say almost all Federal Reserve officials at their June meeting indicated further tightening is likely, and that's what the dot plot shows, if at a slower pace than the rapid-fire increases that had characterized monetary policy since 2022, according to the minutes released on Wednesday. So they're saying that a slower rate of hikes, and what does that pace mean? What does a slower pace of hikes mean? Well, they're still going to hike likely on the next two meetings. It's just that they're not going to do 0.5. It's going to be likely a quarter of a point if it happens at all. What can make it not happen? Just having really good inflation numbers. What can make it really happen? Having lower job numbers. The job numbers thing is tricky, like I said, because we don't know how to even, analysts aren't really good at predicting them. And also, having too low of a jobs number would be really problematic and signal a recession more so than any other figure. Because the job market being tight means that the economy is relatively healthy. And we don't, like I said, though, we're not really good at predicting that. So that's going to be kind of a gray area. But we're going to find out by Friday what these two, one being the ADP, which is private payrolls, and the non-farm is from the government. Okay. CNBC goes on to say policymakers decided against a rate rise amid concerns over economic growth, even though most members think further hikes are on the way. Citing the lagged impact of policy and other concerns, they saw room to skip the June meeting after enacting 10 straight rate increases, probably the highest and fastest in history. Officials felt that leaving the target rate unchanged at this meeting would allow them more time to assess the economy's progress toward the committee's goals of maximum employment and price stability. The first part, I don't think they really care about the maximum employment thing. If they did, they wouldn't be doing this, right? But price stability, interest rates are the only tool they have to control inflation. They have really nothing else other than tightening credit by rolling over their MBS, maybe. They're still doing QT a little bit, but it's not affecting the balance sheet. Not at all. So they're basically saying that they wanted to pause because they feel like they would need to see how the economy will react to so many rate increases already. So they want to see what that could look like with maybe 2 months to think about it. So what did the minutes say about the agreement or disagreement? Well, some of them disagreed as to how that meeting kind of should have handled. Whereas, of course, there's always going to be unanimous support for what the decision is. They're always going to fall into line. But some signal that, okay, if someone wanted to do a rate increase, they wouldn't mind it. They wouldn't mind it at all. And most of everyone says that they want to continue raising rates over the course of the year if there is no progress in inflation. And progress in inflation, well, what could that mean? I mean a market drop in core PCE inflation. Not like the 0.1 we had below consensus last week, but I mean multiple basis points. 0.25, 0.3. And then I think they could come out and say, victory, we did it. Operations, mission accomplished, operation success. But if we don't get some really good beats against consensus, it's likely that the rate hikes are coming. And the market's already priced in the July rate. And they're slightly pricing in a September rate increase. But the market didn't fall considerably. So they're saying that a lot of macroeconomists are having a problem juggling the idea that stocks are going up, but yields are going up considerably to levels of inversion haven't seen in decades, to the what you're probably seeing a lot online if you're into like FinTwit, is how the stock market's outperforming the 10-year bonds. Like the gap is huge. Some people say, or at least one person has said, I don't remember who said it, that the sign, what does it mean that we can have high yields and high stocks? It's more about what the Fed already says. It's really about having a resilient economy in the face of higher rates. It could be because we injected so much cash into the economy over the last 2 years, after, like you can say, last decade, 2 decades, but it's still resilient. Curious how having student loans being paid back and starting in October of this year is going to play into, which would be on average likely hundreds of dollars on households that have student debt, hundreds of dollars a month that they're not spending in the economy. But there's kind of a fix for that. So overall, most of the Fed governors are pretty bullish on rates. Okay, they want to see more rates, two rate hikes by the end of the year, no cuts probably for over a year is what they're thinking. So, but that none of this is really a huge surprise. Like, none of this is a huge surprise. So when the meetings came out, the market wasn't even really volatile. But you could also say the market wasn't really volatile because there's not many participants due to the holiday. There wasn't much activity. There wasn't a lot of volatility, considering the news. Let's move on to the thing that I was talking about that could counteract, maybe people not spending money anymore and paying back their loans. But what's happening is, I want to highlight, is how the reverse repo market is dropping in balance over and over again ever since, I guess, spring of this year, basically, where you were seeing highs in the spring of 2.3, 2.4 trillion. At the end of the year, $2.5 trillion sitting in the reverse repo market, where banks will park liquidity and collect interest. And this is how the federal government helps, put a floor to rates and lock in rates and make rates firm based off how they want it to be. But you can see it's been dropping considerably. So since April, it's down, $500 billion? And where is this money going to? Well, it's going back into some type of market. It could be, banks having to buy bills for all these money market accounts that people are funding. Money markets are seeing some of the highest rates we've seen in a long, long time. And so people that are not interested in parking their money in stocks or in bonds directly, they can get money markets accounts that are paying anywhere from 3.5 to 4.1 interest. Not that much considering how well the stock market has been doing. But anyways, so if a bank is issuing or creating money market accounts for people, they want to put that money somewhere that they can get a guaranteed return, maybe some short-term bills, and the money's coming out that way. But also, the federal government is needing to raise a lot of money, so they have been issuing bonds and bills, and so there is kind of like this unsaid agreement that there's going to be a drawdown of reserves and the repo market. So the banks are the ones that need to be purchasing these bonds to help the government out. So that's what's kind of happening. But the thing about it is, as the reverse repo market comes down, we are going to see a little bit more liquidity in the market somehow, some way. So that's one of the reasons why the market is going up in the face of high yields, is that people thought that with the higher yields and no one really interested in getting bonds, they would have to increase yields even more. And then when it gets to a point, people will get out of equities into those bonds, and we'll have this massive illiquidity problem in the market due to the debt limit ceiling being finally raised. But none of that really played out because the money is being drawn down from the reverse repo market considerably. We touched the reserves a little bit, but the reverse repo market is coming down a lot, and that's what we really want to see. No one's going to graph this chart, but it looks toppy, right? It looks toppy. I wonder how much further this is going to go down. Just to put this into perspective, March of last year, it was at $1.461 trillion before the whole crash in April fiasco, right? And one last thing, we'll talk a little bit more about something Tesla focused, is looking at the expiration for this Friday for Tesla and understanding its max pain, and kind of showing you guys how the market kind of constrains pricing for stocks due to the interest in the options for the underlying. So we're looking at Tesla right now for options expiring on the 7th of July, which is in 2 days from this recording. And first things first, if you don't know, Tesla option traders, I think a lot of them are retail, and they're very, very bullish all the time. Whereas most tickers lately, for months and months and months, have shown a much bearish perspective. There was always not always, but most of the time there are more puts than there are calls, obviously because hedging, but still there's still markedly more puts and calls on most tickers most of the time, except for Tesla, who usually has more calls than puts. And you're seeing in this chart, this volume chart here, which I like to use to kind of gauge max pain. When I use the max pain side, I don't really look at the max pain on the table here. I look at the volume chart to see, but actually the max pain being at 283, that kind of makes sense. Let's look at the volume though. And this is where people are actually making purchases on options, and you're seeing a lot of people buying 280s for this Friday. And what does that mean? We know that Tesla's sitting at 282 right now. What does it mean if there's so much interest in the calls on 280? Yes, I understand the puts and calls, they have a lot of volume, but you can see how it's 90% higher for calls. So how would you as a market maker deal with this situation where you're definitely be slightly below 280 unless this changes, and this can change over the next 2 days. Obviously there's still going to be a lot of people getting more and more interested in getting options as they become shorter dated and much more affordable. But you feel free to take a look at this and see how the volume peaks for either the red, which is the puts, or the green, which is the calls, where they lie. And for some tickers they would be spread out by $1, so the market makers can put the pricing in between and kind of screw everyone else over. But right now we're sitting at 280, and so what they might do is try to make these things as worthless as possible until Friday's close, where they're going back and forth above and below 280 over and over again, trying to get people to close their option orders. If you just want to look at what the open interest is instead of the volume, 285 is getting a lot of interest, but the 280 is right here, and for the open interest, you're seeing kind of a low, I guess, here. And if the volume changes, if people are moving their strikes around, then 280 is looking pretty good for Friday. But watch this. So see if this moves up or down. If the puts move up or down, that's going to be kind of your put support and your call support. When I say put support, I mean there's so many puts at a certain strike. Like let's look at this one, for instance, 220. The market doesn't want to pay out 220. There's too many people that want it to go down to 220. There's too many people that want it to go down to 250. There's too many people that want it to go down to 255. But there's also too many people at 270 and 280, 285. What do you do with this? You're definitely not going to 285. So if there's a lot of calls somewhere, that becomes a call resistance. The resistance where the market doesn't want Tesla to go over 285 because they're going to lose out. They're going to get a lot of shares called away, or they're going to have to pay out a lot. So this is going to be really interesting. Let's do a quick gander at the 21st, which is going to be towards just after and there's not a lot of volume right now, so this chart's not very accurate. But this is going to be the 2 days after the earnings report comes out. And you're seeing a lot of 280s and 300s and the 350s, like I mentioned earlier in the video, with a support at 260 and a little bit more interest coming in the 280. This is a lot. If these peaks stay the same relative, and I know the volume's pretty low, if this stays kind of the same ratio, we can have a problem getting higher by earnings. And the open interest 300 is just very, very, very popular, but I guess 250 is too. This is pretty surprising. So if we're seeing a lot of call, I wonder who's buying this and if this is just some people selling. But yeah, 250 is kind of interesting for that, but we'll see how it changes up as it gets closer to the expiration, the 21st, and of course closer to earnings, where IV is going to go up and options are going to get more expensive. So, well, thanks for listening, guys, and I'll be back with another video for you guys most likely tomorrow. All right, take care.